Hello, this is Chuck Carnevale, also known as Mr. Valuation. If you'd like to learn more about valuation, you might visit my website, mrvaluation.com. This Analyze Out Loud video is associated with my article on valuing growth stocks. And what I'm going to do here is go through a quick analysis of evaluating growth stocks using the contemporary and highly popular company Facebook. I would like to start my analysis on Facebook by looking at it when it went public in May of 2012. And I want to point out this is one of the dangers of investing in an IPO, at least over the short run. From the period May 31st, 2012 to August 31st, you would have actually lost 38% or almost 39% of your money over that short period of time had you invested in Facebook. However, if you'd have been a buy and hold investor that bought it when the PE ratio was actually 42 at the time, based on fiscal 2012 earnings, your rate of return through yesterday's close would have averaged over 45.58%. Now, what's interesting about this is, considering that Facebook lost money, had a negative earnings growth in 2012, that kind of skews their earnings growth rate over this 5-year period. However, watch what happens when you cut out that negative year and look at growth as the company's been through its significant growth cycle over almost the last 3 years. Earnings growth, which includes the estimate for 2015 ending in December, would have averaged over 50% a year. And applying the P equals growth rate formula, you can see that Facebook's stock price has actually followed or tracked earnings. There are times when it became moderately undervalued based on that high growth rate, and times when it became moderately overvalued based on that growth rate. And it is currently trading in what appears to be fair valuation, or a PE ratio of 51, based on that growth rate. But the point of showing this is to illustrate that it was the growth of earnings that generated significant above average long-term returns for shareholders that had the courage to invest in Facebook at such a high PE ratio. But it was obviously consistent with the PE equals growth rate formula. As I pointed out in the article, investing in growth stocks can be very, very powerful and generate very powerful returns. The performance associated with the graph that I just showed assumes a $10,000 investment on 12/31/2012 and held through yesterday's closing stock prices. And that would have turned $10,000 into $40,000, or a 63.1% total annualized rate of return. That's more than almost four times what an equal investment in the S&P 500 would have done. And I think what's important to point out there, this is one of the best return periods in history for the S&P 500. However, as I pointed out in the article, investing in growth stocks can be tricky, and it needs to be primarily based on future earnings potential. Now, common sense would tell us that the likelihood of Facebook continuing to grow at 50% a year or more going forward becomes highly unlikely, considering that the company now has a market cap in excess of $305 billion. The current consensus of a very large group of analysts, this is obviously a very popular stock, are assuming earnings growth rates averaging approximately 28% over the next 3 years or so. Now, that's still an extraordinary growth rate, but the caution here is buying that type of earnings growth at a current PE ratio of 51 could be quite dangerous. If the company held that high PE ratio, you could in fact make over 29% a year. However, if the PE ratio shrunk to 40 times earnings, which is still very high, that rate of return, although still exciting at almost 22%, would be a lot less. And if it fell to its, what I would call, earnings justified level based on the P equals growth rate forecast, that rate of return could drop down to 7%. On the other hand, for those of you willing to take a longer view, there are 15 analysts willing to provide a 3 to 5 year forecast on Facebook. And those analysts have a median average of 29%, just slightly over 29% earnings growth. So even if you apply the P equals growth rate formula there, that would still imply that Facebook could earn almost 17% a year, assuming that its PE ratio shrinks to 16.95. Or excuse me, if its PE ratio shrinks to 29.25, which would be equal to its growth rate. Of course, if the company maintained higher PE ratios, which it's liable to do for a couple of years, then you'd still have the opportunity to generate very high returns. This simply illustrates the power of compounding. But achieving high rates of growth get very, very difficult as a company gets larger. And at $305 billion, even as good as Facebook is, and the fact that they have no debt on their balance sheet would still be a very challenging growth rate for them to go forward. So I would consider this an overvalued growth stock based on forward earnings here. But as I also pointed out, based on its historical growth, it would look fairly valued. Investing in growth stocks is tricky, and you really need to focus, in my opinion at least, on what the future growth potential is and what you're paying for that growth before investing in growth stocks. This has been Chuck Carnevale saying thanks for listening.